Hi, this is Greg Goernert of Goernert Wealth Management, and this is my Insights and Perspectives podcast. Welcome to the June 15th episode of my Insights and Perspectives podcast. Today, joining me from Montreal is Canaccord Genuity Chief North American Portfolio Strategist Martin Roberge from a monthly Business Toolkit segment. This month's segment will focus on protecting your wealth. I know that you've got a cautious take on the markets.
The global growth slowdown over the past year is now hitting U.S. shores.
As usual, since I've got Martin on the line today, I'll dispense with my usual 2-minute commentary on the economy and the markets in general, because Martin can do a far better job than I can on it. He's just come out with a particularly bearish report on the outlook for North American markets and the economy in general, and I'm looking forward to hearing his thoughts. Now, to Martin. My guest today is Managing Director of North American Portfolio Strategy for Canaccord Genuity. Welcome, Martin Roberge.
Thank you, Greg, for having me.
So, Martin, why don't you walk through a little bit, because I know that you've got a cautious take on the markets over the past number of months. You put out a great piece back, I believe, in April, being probably one of the first analysts to really sound the alarm that, perhaps the market has gone too far, too fast, and the recession risks are definitely rising. Can you just expand on that a bit and your thoughts on the market as a whole?
Yeah. First of all, we use several economic-driven models to try to gauge market risk and economic risks. So, and these robots, if we can say, have noticed the global growth slowdown over the past year is now hitting U.S. shores and Canada to a certain extent. And while global growth and U.S. growth is slowing down, the models are asking for an opposite force to outweigh this deceleration. And those reflation forces have yet to be seen. Fortunately, lately we've seen the Federal Reserve and the bond market anticipating and predicting some rate cuts down the road. Obviously, these rate cuts have to be delivered. That's mandatory. If not, we need to see U.S. commercial banks easing their lending standards because so far demand for borrowing is very muted. And lastly, financial market variables such as oil, bond yields, the U.S. dollar must stay low in order to provide a bottle of oxygen to the global economy. So in a nutshell, the risk is that the economy, both in the U.S. and globally, is decelerating, while we have yet to see some opposite and positive force to counteract this slowdown. And that's why these models are on a high risk alert for now.
Yeah, because it seems to be the markets seem to be focused on the USChina Trade negotiations, and somehow that seems to be in the minds of some a silver bullet. They solve that, everything's going to be fine. But hearing you and listening to you, the problems are much deeper, that we still do have higher interest rates and a decelerating growth going forward. So what are your thoughts on any resolution to the Chinese-American trade negotiations?
This is a very good point, because beyond the U.S.-China trade tensions, like our tools, our analysis, even before the tensions started to pick up earlier this year, our models were already flagging global growth deceleration. So the fact that we have now rising trade tensions is just compounding the risk globally for more protracted global economic slowdown. So down the road, what as an investor we must probably anticipate is that if these tensions remain for the next year or two, China will probably try to build trade relationships with their close neighbors and that includes Japan and Europe. And as a whole, we could have a new superpower economic bloc called Eurasia, where this bloc becomes so powerful that eventually it could put at risk some of the U.S. multinationals. So overall, I think we are in the early days of Eurasia becoming a new economic bloc, which will isolate the U.S., Canada, and South America from the rest of the world. And down the road, this is obviously positive for all the countries that are close to Asia, okay, because this is where global growth is concentrated. And this is also where central banks can ease rates. So from an equity portfolio approach, it's very, very important that your listeners and whoever is involved in managing money make sure that a big portion of their equity allocation is invested in that emerging region where growth attributes are likely to be superior or better than in North America. It's basically the opposite of the past 20 years.
Now, that's an interesting point because you did bring up more emerging markets. So what else are you seeing in emerging markets as far as growth rates going forward, aside from China? And then maybe we could talk about the BRICS as well.
Yeah, this is growth. As you know, growth numbers are higher because the percentage of industrialization is way lower than where we are in North America. But one of the things that we're seeing in emerging markets is that inflation is no longer a problem. In the past, especially when the Fed was rising interest rates, central banks in those countries were pretty nervous because their currency would go down, and then they would import inflation from abroad. And as you know, these countries are very sensitive to food prices or essentials because they import a lot to feed their population. But now we have this situation where emerging markets are enjoying the same tailwinds from an inflation point of view, that meaning the internet economy is now dampening inflationary pressures also in those countries. So now central banks are more flexible and are less reluctant to raise rates when the Fed does increase interest rates. But on the way down, when inflation is falling, they can accelerate the pace of reflation, which is exactly what we're seeing right now. So one thing about emerging markets that we have to realize is that inflation is no longer a roadblock for central banks to ease rates, hence protect or boost economic growth. And this is going to be the story for the next probably 5 to 10 years. And that's why we have to have some allocation in those countries.
Now, that's a fascinating development because that's never been the way it's been in the past. And in a way that changes everything. So let's step over to Europe, if we can just touch on that again, because that, to me, from what I'm looking at, things are looking relatively dark in Europe. We've got negative interest rates in Germany. Can you expand upon your outlook for Europe as well?
Yeah, Greg. Let's call a cat a cat. This is outright awful in terms of economic performance so far this year. There's no doubt that if you look at Europe as a whole, the continent will be experimenting probably a classic recession. But we have to remember as an investor that companies in Europe are not only doing business in Europe.
That's a good point.
A lot of these companies are multinationals as well. You look at the CAC 40 or DAX 30. Those are large cap multinationals doing business in every single part of the world. So a big chunk of their revenues are not domestic centric. Okay, so we have to remember that, like in the U.S., we've got a lot of multinationals, but they have their own also in Japan and in Europe. So overall, it's an opportunity for investors to realize that these stocks and these markets have been beaten up so badly, and market participants are not yet discriminating in terms of their geographic exposure, such that valuations provide a margin of safety that we cannot find in Canada or in the U.S. right now. So from a starting point when it comes to reducing portfolio risk, starting with some allocation into like East and Far East markets and emerging markets, overall international equities is obviously a good place to invest. And as you just said, Europe right now is so much under pressure that some of the stocks are already reflecting the possibility of a recession, while in North America, it's the opposite.
Now, that's a good point, too. Now, I know that that you've come out and said that it's a riskier environment for stocks, and for your portfolios, you're cutting equities by about 4% from the last report that I read. Where are you allocating those funds now?
It's primarily, I would say, international equities.
Okay.
Okay. EFI and emerging markets. Second would be Canada, but Canada we have a very, very strict strategy of focusing mostly on high dividend yielders, because Canada, like we know about the challenges that we face, but the structure of our market is that Canada is probably one of the highest dividend yield market in the world. So in terms of dividend yield strategy, Canada is the place to be. And then U.S., well, you've got lower dividend yields and a higher market multiple. So that's at the bottom of our list. It's basically like, Greg, we're positioning for the opposite of what we've seen over the past 10 years, whereby U.S. equities have outperformed world equities by a wide margin. We're taking the opposite bet going forward.
Okay, now you've had some comments on base metals and on commodities in general, particularly the metals. Can you talk anything about copper and the other base metals going forward? Because we know we've got maybe some supply issues, but also we've got some macro issues that are in the market as well.
Yeah, right now macro issues are overwhelming the supply issues. Copper is highly sensitive to sentiment on the global economy, and as such, we've seen copper prices going down. But again, we have to be smart about copper and realize that the bulk of copper demand comes from China and India, which account for about 50% of global growth. Okay.
Wow.
And what have we seen lately in terms of reflation efforts? We've seen the Bank of India cutting rates 3 times this year, and the Bank of China unwinding or delivering another fiscal package to boost the economy to offset the trade tariffs. So we know that the reflation in India and in China will eventually translate into stronger copper demand as this money filters through their economy. So in the near term, we've got some macro concerns. Don't get me wrong, but when you look at economic leading indicators and reflation measures, like China and India, call it like Chindia, is probably the bottle of oxygen that copper needs to stabilize. And down the road, we know that the supply issues will take care of copper and provide some protection. So this is probably by far our best commodity in terms of our pecking order, because we've got the supply, the support, and the reflation we're seeing in emerging market will translate into stronger copper demand in the second half of the year. So copper stocks or copper as a commodity, we believe is a good risk reward ratio here.
Perfect. Now, what else are you looking at and focusing on? And maybe the other thing I would put in, what would have to happen for you to change your opinion of the U.S. markets right now? Like if the Fed cuts rates a couple of times, doesn't seem like that's going to make any difference in your mind for your models. Is there one thing out there that would change your opinion, or do you think we're already well on that way?
Yeah, okay, so 2 things. First, the cuts must translate into higher bond yields. The bond market has told us way in advance that there was an economic slowdown coming. now it has to tell us that growth is reaccelerating. So we have to see bond yields rising, like probably way closer to 2.5, and maybe 3%, for the yield curve to really steepen. Not steepen because short rates are falling faster and long rates are staying stable. We need to see an outright steepening, like lower short rates, higher long rates. That's number one. Number two, we have to make sure that the rate cuts are passed to the consumers in the U.S. because right now, even if the Fed is on hold, U.S. commercial banks are the ones keeping the economy, are putting the economy at risk because they are seeing delinquency rates rising, like in the credit card and the auto lending business, and now they're a little bit more conservative in terms of their lending conditions. So we need to see U.S. banks easing their lending standards and lending money to consumers and corporations so that we've got this credit cycle going for another year or two. But this is not what we're seeing. But should we see it, we would probably turn more positive.
Perfect. Well, why don't we leave it there? Martin, thank you so much for taking the time to share your insights with us. Fantastic. And we definitely be sure to be reading your research reports coming out. Thank you very much, Martin Roberge.
Thank you. Bye-bye.
Bye-bye. Hey, thanks for listening. Don't forget to subscribe and visit us at our website at greggoernert.com. That's GregGoernert.com. Thanks again.